Many experts have welcomed the government's decision to ease foreign direct investment or FDI norms for China and other countries that share land borders with India. India earlier this week allowed overseas firms having up to 10% shareholding from these nations to invest in the country without mandatory approval. Some experts believe the move will boost capital inflows and strengthen supply chain integration.
At this juncture, this is a great step that India has eased FDI norms for China and other land boarding countries, allowing investment with up to 10% beneficial ownership under the automatic route. This is, I would say, a great step in the trajectory of liberalization. So this amendment, I believe, has been made under the Press Note 3 of 2020, which was originally introduced during COVID-19 to prevent the opportunistic takeover of Indian companies because of the spread of pandemic.
The government has also proposed an expedited approval process of 60 days for investments in key sectors such as capital goods, electronic components, polysilicon, advanced battery components, and rare earth magnets. Some experts are of the opinion that the move creates an opportunity for Chinese capital to enter the Indian economy at a time when India's growing investment requires additional external funding.
India is a growing economy which needs a lot of capital but does not have as much capital as the domestic economy demands. To put in simple words, we don't have enough money to invest in our own country. So that is why we are looking for the extra amount of money from rest of the world, which we are trying to invite them. So essentially, and we also know these land border countries or LBCs, whichever way you put it, the entire provision actually came, principally towards the China.
However, there's a sense of skepticism when it comes to expecting significant technology transfer from China through these investments.
If we look at the tussle between the United States and China, then of course, one of the theaters is technology, nothing but technology. So I don't think that China will be very much willing to disseminate even partly some of their technology here. But yes, you can say by the simple rule of market, some amount of technology always percolates into the domestic economy. So that way, maybe yes. But if we are expecting to have a situation where there will be huge kind of technology transfer from China to India, I don't think that is going to happen.
It is believed that easing investment restrictions could also help reduce India's trade deficit with China. Estimates suggest that bilateral trade between India and China could reach $155 billion in the financial year ending March 31, 2025. Of this, India's trade deficit is projected to be around $116 billion. Though India has received minimal FDI from China, the bilateral trade between the two nations has grown multifold. China has emerged as the second largest trading partner of India. In 2024-25, India's exports to China contracted 14.5% to USD 14.25 billion. The imports, however, rose by 11.52% in 2024-25 to USD 113.45 billion. During April-January 2025-26, India's exports to China rose by 38.37%, while imports rose by 13.82%, with the trade deficit at USD 92.3 billion.